Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and the long bond, something we don't talk about very often. Seeing a pretty big move over the last several days, a 15 basis point rally in yield. Takes us up to as high as we've been over the last 3 months. And then we subsequently pull back today, about 50% of that. So big moves over the last 3 days. Today's inflation data not as Fed friendly as they'd hoped. The market quickly reprices, as we saw over the last, like I said, the last 2 days. It was just basically a shoot straight down in price, straight up in yield, and the market really kind of turned around today. Likewise, we've got data again tomorrow. We've got CPI tomorrow, so there's still some hope out there that perhaps consumer prices will be showing more higher levels than the producer prices did today. But likewise, we also have some bank earnings coming out tomorrow. So there's a lot still to come before the end of the week. And if you look at volatility, we see these moves, these breakout moves. We talk about breaking the trend and seeing volatility spike or seeing volatility decline, which has really been the story since the beginning of 2017. Volatility is up. It's not down today. However, it is up so little that you wouldn't really give it a second look. I think that right now, as we head into CPI and bank earnings, which are I think the two next major events, even bank earnings that extend into next week, those are what's going to keep volatility from going down. Right now, the positioning is such that the long end of the curve remains the place to be. The curve still has a flattening bias, despite the fact that we've seen an uptick and we've seen it steep, and the long end has been outperforming, albeit we are starting to see some of that chisel away. And why did we see that big move this afternoon in the bonds? Well, we had a stellar 30-year auction, one that was not expected, I think, to be as strong as it was. There was question about whether there would be demand for a bond that when you come in, we really weren't on the highs. We were trading around 287 yield. If you go back to last year, we traded as high as 321. So we really weren't at the all-time highs or at least the one-year highs that would have attracted a lot more buyers. But yet, lo and behold, we did see a bid to the market on the auction, and that's really what's taken us into these afternoon levels. So right now, the long bond starting to show signs of really getting out of that, knocking itself out of that bear mode that we saw over the last 2 days. Now, it's still too early to tell, and we get through tomorrow, we get through the earnings, we get through the CPI, that'll give us a much clearer picture. But right now, the long end of the curve is still going to see a very whippy trade. We're going to continue to see bonds outperform, I think, on the longer term versus some of the lower durations in the 2 and the 5 year, and that's going to be the thorn in the Fed's side, because right now, with no inflation and a very flat yield curve, the Fed has probably not likely to have too many bullets left in its gun to raise rates as far as the rate hikes go for 2018, which right now are priced for 2 25 basis point rate hikes with the possibility of a third. So 30 years, still bullish despite the move we've seen this week. This is Todd Colvin coming to you from the floor of the CME Group.